good morning. Thank you for joining us for the fourth event in our series, which is focused on exploring the key factors that contribute to agency success and the essential steps that agencies owners should take to build value in their business ahead of a potential sale. For those of you who couldn't attend our previous event, we launched our latest research paper, which is How Agencies Stay Ahead, the DNA of Winning Agencies. And that was based on insights from 10 high-performing agencies, where we had in-depth interviews, and our report explored the key themes and learnings and behaviours that came out of their successes. So if you would like a copy of that, please do let us know, and we'd be happy to share that with you. Again, I always say there's lots of familiar names on the delegate list, so many of you are familiar with who we are, but for those of you who aren't, we're a UK top 10 audit, tax and advisory firm. We work with entrepreneurial businesses across all different sectors, as well as not-for-profit and private clients. We're also part of More Global, which is an international network with presence in over 100 countries, so very well placed to help our increasingly internationally focused clients with their overseas operations. And at our West End office, we specialise in working exclusively with media clients. So that spans marketing services, film, TV, theatre, gaming, actors and entertainers. And we've also got a media and marketing services M&A specialism. Obviously, you'll be hearing from them today. And that sits within our 40-strong corporate finance team. And over the last 5 years, the team has successfully completed over 60 media transactions with deal value of over 800 million. They work very closely with our M&A tax specialists as well, tax obviously being an important part of any deal. And recent deals that they've worked on together include the sale of Total Media Group to Service Plan, and of course you'll be hearing more from Guy Sellers about that later on. The sale of Wushu Studios to Keyword Studios, the acquisition of Shout Bravo by Incubator, and the sale of CC Group to Hoffman. You may also heard about our recent mergers with Shipley's and Statham Guild Davies. So Shipley's is a recognised leader in the film, TV and animation production world. They joined us last year, and they really have enhanced our capabilities with their specialism in tax credits in the film, TV, animation and video games landscape. And meanwhile, our established legal services team have merged with Statham Guild Davies, which is a law firm which is renowned for its expertise in music and entertainment. And together they now form More SGD Law and offer a full suite of legal services. So now on to today's session. So exit, permutations, aspirations and valuations. So our panel are going to be sharing their first-hand experience and practical advice on how agency owners can best plan their exit. And this will include identifying things like the right timing, lining up shareholder aspirations, and exploring the many routes, exit routes that are available. Before we head into that discussion, George Hatswell from our media corporate finance team is going to just talk you through our latest quarterly media M&A update. So before I hand over to George, a couple of quick housekeeping points. We are recording the webinar, so please do share it with your peers or any of your colleagues who were unable to make it today. This webinar is for you. We want you to get the most out of it. So please do ask any questions that you want to, and please do that in the Q&A function, because it's much easier to hear and keep track of them there. And lastly, we want to hear about your thoughts and suggestions for future webinars. So there will be a very quick feedback form at the end. So please do fill that out. So I'm going to hand over to you, George.
Thank you, Esther, and hello, everyone. Let me get my slides up and then we can kick off. Okay. So back in January, we looked at what had happened during 2024 in the marketing services sector from a mergers and acquisitions point of view, tracking all deals with a UK presence. 2024 was a bit of a bumpy ride with a strong first quarter, then deals pushed through in Q3 and the start of Q4 in anticipation of capital gains tax hikes, which weren't as severe as expected. We now have data on what the first quarter of 2025 looks like. Now, I must caveat this by saying that it usually takes a week or so for all the deals at the end of a quarter to make their way through. So timing of the webinar isn't ideal from a data completeness point of view, as we expect the end of March close deals to come online in the next few days and bump these figures up slightly. Nonetheless, the story it tells is steady rather than spectacular. I suspect a few deals that may have been meandering along were given a shot in the arm before the autumn budget. So Q4 of 2024 was artificially high, much to the detriment of the first quarter of 2025, where we saw 50 deals with a UK presence. So delving deeper into those numbers, what goings on have we seen recently? Sorry, those slides there. A key ongoing trend is data, analytics, and AI capabilities. AI is all about connecting data sets that haven't been connected before. And for AI to work well, good quality data is imperative. In the last 5 years, we've seen a rising trend of data analytics platforms and data sets in deals, with the last 12 to 18 months now including AI-driven capabilities too. In March, Publicis announced that they would be acquiring Lotame, an end-to-end data marketplace delivering consistent and addressable audiences built on over 100 data sources and activated through more than 1.6 billion IDs, with the world's leading brands and publishers then able to leverage these at scale and with precision. Following the acquisition, Publicis now believe they're connected with 91% of adults on the internet. On a slightly smaller scale, and probably slightly worryingly for some of the people on the webinar, accountants are continuing to make further moves into the sector. In February, accountancy group Cooper Parry acquired Frontfoot, a London-based data and intelligence consultancy with a wide range of clients, including publishers, retailers, and both worldwide and independent digital agencies across multiple verticals. Data and analytics was the most acquired capability in our 2024 review of deals in the sector, and we expect that trend to continue going forwards. Next up, social, e-commerce, and influencer. Global ad spend on social media is expected to exceed search spend for the first time ever this year and account for 25% of all ad spend in general. This is driven by a continued rise in social media spending in Europe, following behind the US and Asia, as consumers are increasingly looking to purchase goods promoted by influencers and through social channels. Social platforms are increasingly becoming commerce platforms, with consumers able to spend directly without ever leaving the app. This is generating more revenue for influencers and creators who are becoming increasingly aligned as affiliates through promotion of products to their followers. There have been a few high-profile deals in the sector in the last few months, which we see as a sign of things to come in the market. Technology and data-led influencer marketing agency Campfire, based in Manchester, received funding from Literacy Capital. Literacy will be looking to help Campfire grow both organically and through strategic acquisitions, focusing on their technology-centric proposition. London-based Cooler, a social media and influencer agency, took investment from Growth Capital Partners in November, with a view to expanding their service offerings and continue the growth trajectory to date. Then finally, last month, private equity house Bridgepoint reinvested to become the major shareholder in social-first digital marketing group, Sammy Alliance. Sammy, initially based in Madrid, have made acquisitions in Europe, the United States, and Latin America, with the new investment raised to help them expand their capabilities and verticals further. The rate of change and investment in the sector is a great opportunity for social-first and e-commerce agencies to grow their businesses and expand their offerings. We're anticipating a wave of future social, influencer, and e-commerce deals this year off the back of these investments, particularly in the case of Campfire and Cooler, who will be looking to bolt on smaller agencies to increase their scale and capabilities. It's been an intriguing few months in relation to the networks. Earlier in March, both Omnicom and IPG shareholders voted in favour of Omnicom acquiring IPG, targeting the deal to complete in the second half of the year, which would create the largest of the networks by market capitalisation, overtaking Publicis. However, the deal is still subject to regulatory approval, and rumours in February were that Elon Musk was putting pressure on IPG to increase their client spending on X, formerly Twitter, in order to receive ratification of the deal from US regulators. A theme that we believe will continue through 2025 and beyond is the number of carve-outs. Alongside the Omnicom deal, in March, IPG spun out creative innovation agency RGA from their portfolio, selling it to American private equity house TrueLink Capital, with TrueLink pledging to spend a minimum of $50 million establishing a new innovation fund as part of the deal, enabling the business to invest in new skill sets, talent, product development, and future acquisitions. WPP have also been selling off assets recently, with the American private equity giant KKR buying WPP's 50% stake in FGS Global in December. Then, in January, Kantar Group, which WPP still holds 40% of following the majority sale to Bain Capital in 2019, sold off its media division, accounting for 15% of group revenues to private equity group HRG Capital. Insiders are now suggesting that Bain and WPP are looking to break up and sell off other Kantar departments, including Numerator, which was merged with Worldpanel in January to form an entity that holds first-party consumer data on over 5 billion people. Finally, Mission Group, who rejected a takeover bid from Brave Bison last year, sold off full-service agency April 6 to US-based growth consultancy MarketBridge in January this year. These carve-outs are a sign that some of the networks feel they have too many moving parts and need to focus their propositions and increase their agility, which was telling in 2024, with the number of deals done by the networks significantly down on previous years and almost driven entirely by Havas and Publicis. We expect the number of carve-outs to continue increasing in the space, driven by private equity and increasing the number of potential buyers and competition in the sector. 2024 saw a large number of deals, but it was also a tricky year for agencies. Advertising budgets stagnated, and lots of agencies struggled to increase fee income ahead of inflation. And if that wasn't bad enough, wages also increased as agencies have tried to retain staff, which is key to delivering great quality work for clients and delivering value for agency owners. The result of this for lots of agencies and owners thinking about selling is that timelines for sale have been pushed back as profits have dipped and the potential value of their business has fallen, which has reduced the amount of agencies coming to market for potential acquirers. There is a fantastic, ever-increasing pool of acquirers out there, with demand driven primarily by the PE-backed challenger groups who are looking to expand their capabilities and market shares, where growth must come both organically and through acquisition in order to deliver the financial returns that their backers desire. As is the nature of digital and connected working practices, this demand for UK agencies is being driven from around the world, with the greatest change in demand being from the United States, where capabilities aren't as well developed as here in the UK. There is significant demand for deals in the space from acquirers who are willing to spend and compete with each other for agencies that are performing well. This, paired with the restriction in supply, means that for agencies with sought-after capabilities, we're seeing good multiples and valuations being paid at the moment. The only caveat to this is that we're seeing a shift to more earn-out-based deal structures with slightly less cash up front, reflecting the continued uncertainty in the economy. However, if you are thinking of going to market in the near future, don't hesitate to get in touch, as the timing of the market right now could be perfect for you. So thanks for me, and back to you, Esther.
Thanks very much, George, and hopefully we do see that improvement in the marketplace over the coming year. So next we're going to move on to the main topic of today's webinar. So selling an agency obviously is a major life event and probably something you're only going to do once. And over the last couple of months, you've heard about the steps that you can take to get your business exit ready. And equally important, obviously, is how this links in with what you, the founders, are trying to achieve. And there's never been more exit routes available, and we'll come on to that a little bit later, but it is important that you pursue the right exit for you, your agency, at the right time in order to maximise the opportunities that are available. And navigating this complex path are the key elements really within our agency exit programme, which you can find more details about on our website. So introducing our panelists, if you want to switch your cameras on, Guy and Paul. So Guy joined Total Media in 1983 during its first year of trading and helped build the company from just 3 staff and about the same number of clients to 170 staff across offices in Soho, Central London, Manchester and Birmingham. And at the time of the sale, the company had grown billings to 180 million. Along the way, Total Media acquired 3 further agencies, started a JV in Manchester and opened and closed a digital agency in Tallinn. And since selling to Service Plan, which obviously we'll hear a bit more about, Guy is now chairman of Mediaplus UK. Guy is joined by Paul Winterflood. Paul leads the firm's media corporate finance team, specialising in transactions in the media and technology sectors. And Paul regularly speaks and contributes on the topics of selling your media business and talking about the media and technology M&A landscape. Paul's got experience advising entrepreneurs, strategic acquirers and private equity investors. And he's very passionate about the importance of creativity and culture in terms of getting deals done. And clients appreciate this, as well as his sector knowledge and experience. Some of the notable transactions that Paul has been involved in include, obviously, the sale of Total Media Group to Mediaplus, 23Red to Capgemini, People Made to the Positive Change Group, the Theatre Royal, Haymarket to Access Entertainment, and Two Eyes Investment from Rockpool. So we've got a series of questions to ask Guy and Paul, but like I said, please do pop your questions in the Q&A function if you want to ask some questions as well, and I'll try and weave those into the chat as we go along. So Guy, perhaps starting with you then. So do you want to tell us a little bit more about the sale of Total Media to Service Plan, I guess who Service Plan are and how the sale came about, really?
Okay, thank you. Morning. Service Plan are about 50 years old. They're a German independent, I think the biggest independent agency group in Europe, certainly by far and away the biggest in Germany. They've got about 35 offices, Europe and across the world, but mostly Europe. And they didn't have an office in London, so that was pretty critical. How it came about was 23rd of June 2016. You remember there was a vote which went towards leaving Europe, and given quite a lot of our billing was there at the time, we felt we just needed friends, which ended up meeting various people, but specifically Florian Haller, who owns, or his family owns, Service Plan in Munich, and realized we had quite a bit in common in terms of gaps in what we needed. They needed London, we needed Europe, and so on and so forth. So it started really as like a mutual trading relationship, and that was it. There was no talk of sale at that point at all, but it was good chemistry, and that for us was important to discover.
You've got quite a diverse range of shareholders. Well, you had within Total Media.
Right.
And what sort of steps did you take and go through to ensure that everyone was aligned with what the deal would deliver? And when did you sort of start thinking about that?
Okay, so the primary shareholders, myself and Mike Sell, who's now retired, and we at that point, around about actually 2018, we thought, well, at some point or other, we will probably move towards a sale, but created an EMI scheme for the rest of the board, and that was structured to, if you like, protect the early investment myself and Mike had put in, and reward the board as the value grew. So that was very effective. Close to the time of the sale, we put in a secondary EMI scheme for the next layer of management, and thus far it's worked very well. We've now got a year beyond the sale, or nearly a year. We've kept the team, and they're all aligned with us in terms of what we're trying to do.
Yeah, that's really good. And Paul, I mean, obviously you've been involved in lots of different deals and seen different sort of pools and groups of shareholders have to align themselves. I mean, how important is it to make sure you understand all of the different shareholders' aspirations?
I think it's a really critical aspect of a deal, and I think it's really important to address it early on. It very much underpins so much relating to an exit, regardless of the exit route you ultimately go down. What you don't want to be in is in a situation where major differences come out late in the day if you're in a transaction process, or even, regardless of whether that's to a third party or even if you're doing an MBO or a different routes. It's far better to do that when the pressure's off. I think there's various components to that as well. Obviously, everyone would be thinking about the financials. How much are you looking for? I think that is also an important aspect of it. So, what is dictating that? What is dictating that price? As an advisor, I'm looking to understand what is driving it. Is that a value that's been calculated? Where each shareholder has been working with their IFA to calculate how much money they need. Our IFA team often say that a lot of people overestimate it in relation to business valuation. So I think that is definitely an important step that people should go on. Timing.
We mean overestimate what they need, or overestimate what the business is worth?
Overestimate what they need.
Right.
Is what our IFA team regularly report back to us. I think the second thing is around timing. What do the different shareholders want to do, and when? What does each shareholder want to do? To do post deal. Some people might want to stay in the business. Some people might want to, if anything, accelerate the business and take some risk off the table. Others may want to leave the business. In fact, there's a deal I advised on last year where there was the two major shareholders. One wanted to leave immediately. And this was a private equity transaction. The other shareholder initially was thinking he'd go down the trade sale route, but then found out more and more about private equity and thought, okay, I quite like to give this a go as almost the final chapter in his career, going on a growth journey, going on a buy and build. So this is so individual, and so I don't think if you've not discussed that, you don't necessarily bring things like that out. Timing is also clearly linked to the financials, and that's obviously heavily linked to valuation, and all of that is very much interlinked. And so the planning needs to be linked to the commercial setting of the business. And if we go back to the value drivers, if you've got if there's a valuation gap between what the business is worth now and what the valuation you're looking to achieve is, then it's important to go on the journey to identify areas to close that gap. Another point relating to timing is you don't want to get to a situation where the key shareholders almost fall over the line. We've heard about earn-out structures, and we've heard that if anything at the moment there's higher elements of deals relating that are being put through earn-outs. So that again is a key part of a sale timeline. The final area then is also around what your aspirations are for the business. Some people want to stay independent. Some people want to grow the business. Some people are very. I think it's really important to retain the culture without any outside influence. Want to promote shared ownership. I think that those are just important things to get on the table early on, so that you can pursue an exit strategically and purposely.
So quite a lot to think about. So I think it is important to make sure you're thinking about that early doors, and that there's a degree of honesty as well amongst shareholders, by the sounds of it. You alluded to the key value drivers. I mean, one of the things that we do is a key value drivers sort of half-day workshop with senior leadership teams And we sort of talk them through the key value drivers, the 10 key value drivers that sort of deliver value into an agency, and help them to sort of assess where they are and where they sit against those key value drivers and which need improving, and how they prioritise those that need improving. And Gaia, I forget when it was, maybe sort of back in before 2020, but the MKS team led you through a value drivers workshop, didn't they? And how did this sort of contribute towards you working towards an exit?
Oh, it was definitely worth doing. It was helpful. There are a lot of values. So, and we got the charts back. The key one is the strengths in green, I believe, and then the weaknesses in red, and then all these medium things. But the thing to do is not be put off, is to and not just go for the weaknesses. You know, you want to go for the strengths and boost those, because they're the ones that give you proper standout. So for us, our positioning was getting noticed, and so we felt, well, we need to work on that and build on it. You know, the behavioural understanding, if you like, is what our platform was, still is actually. Weakness, you know, we were just not profitable enough. We'd grown our billings quite strongly over, you know, the previous few years, but the actual the gross income was catching up, but the profit wasn't. So that was a proper focus for us to get right. And then the last one was brand strength, which we interpreted as fame and if you like, PR. We worked with Propeller and Martin Lowe, and that really helped build, if you like, the positioning of the behavioural concept. So I think it used to be referred to as self-called behavioural agency, and actually then it was just referred to as behavioural agency. So that worked well for us, and I think it was just focusing on those three areas which really helped us.
Yeah, and Paul, I mean, you know, your experience of having done lots of these with different clients, it really can make a difference, can't it, if you just improve a few of the value drivers that aren't working well currently.
Yeah, absolutely. I think for as a shareholder or as a member of a management team, there's so many things that you can do. You could spend your life trying to improve various areas of the agency, but I think what's really important is being able to identify what are the key ones that are going to deliver the biggest uplift in value and also saleability in advance of an exit. And if you're working to a timeline, that prioritization point is really, really important.
Yeah, exactly. There's only so many hours in the day. I mean, Paul, coming on to sort of you know, we sort of talked about permutations in the title of this, in terms of, you know, there are lots of different exit routes that are available to agencies. Maybe sort of talk us through some of those and some of the ones that are more popular at the moment.
Yeah, absolutely. I think just reiterating George's point, for successful agencies, there's never been more options and exit options available. If I talk through the most frequent paths, so firstly, from an M&A perspective, over the last 10 years, there's been a proliferation of acquirers, primarily driven by private equity coming into the market. Private equity aren't going anywhere in this space. You heard about the carve-outs that are likely or that are happening from the networks. That's going to continue. There's been success stories in the space as well. So we're going to see the private equity houses such as LDC, I imagine, reinvesting in new opportunities, having successfully taken the likes of Crowd and MSQ on the journey. We're seeing new private equity houses look at the market and think there's opportunity as well. So that is absolutely driving activity. I think what that means from a sale perspective is there's a real range of different types of acquirers, and the key to good M&A in this sector is cultural fit and the synergies and opportunities that creates. And every single different type of every single buyer will have different nuances and opportunities, and that's going to be individual to the business that's being that's being sold. And so it's important to work on the positioning purposefully so that you can understand where in the market you might you might sit and what you're looking to get from a potential acquirer. Sorry, I'm talking about private equity a lot, but the next one is also private equity direct. So these are what would be described as platform deals. Typically, this is where these are you'd need EBITDA probably north of 2 million, certainly north of 1.5 million, and private equity are backing a plan to double to treble the size of a business over a 3 to 5 year. Like double to treble the valuation of a business over a 3 to 5 year period. Typically in this sector, pursuing both organic and inorganic growth. And as I mentioned before, that can be a attractive proposition for certain management teams. I would say that the key thing that private equity are looking for in this sector is the ability is backing the management team and their ability to grow the business. You're not going to end up with much value if you're just trying to create cost synergies. It's all about growth, and it's all about backing people and management, and that could be a great way to retain a culture, because you're not being absorbed into a larger organization. So clearly that one in particular, I think, is the I guess the ambitions and what the leadership team's aspirations are over a period of time. That very much links very directly to whether that can become that is a possible option or not. The next one, which is related, but I'm more referring to debt-funded ones, are management buyouts. So these I would say in this space probably there's a reasonable number. They're definitely an option. These are attractive because it's potentially easier to agree a valuation. I would say they're potentially underestimated because there's always I think they're often seen and as very I think every MBO I've heard of, they're always positioned initially as this is a very friendly MBO. It's going to be really smooth sailing. There's always points along the road where it's a negotiation. There's going to be both sides have to get advice. There's always going to be emotive points along the way, and actually in MBO settings they can sometimes be a bit harder to agree at times, and can mean that process in particular can be stop-start. MBOs often mean it takes longer to receive your money than it would do as a shareholder for you to receive your money than it would do selling to a trade acquirer. They're normally debt funded, so a combination of vendor loan notes. So what we mean by that is that effectively the shareholder is being paid out through profits, either through an earn out or deferred consideration over a period of time. You can sometimes get some debt financing as well. I think that is more challenging in the agency space relative to an asset heavy business. And particularly if you've got a low level of retainer income, that's going to be quite hard to get significant levels of debt into an agency. But it's still a route available to agency owners. Similar but quite different is a sale to a employee ownership trust. They are very popular for agencies. I think we've seen and advised on a number of those over the last few years. I think particularly for businesses where culture is so important, that the appeal of shared ownership throughout the organisation is a strong driver here. And so for some agencies, a sale to an EOT really does match the values. There definitely are pitfalls that you should be aware of, and similar to management buyouts, it's going to take longer for that cash to be received. That's going to be you're going to be paid out through the profits of the business. You can sometimes get debt in, but similar to MBOs, it's going to be for agency businesses that is quite challenging. I think the important thing is working out what's right for the shareholders, the management team, and the business. And each business is unique and will thrive in different environments, which regardless of what the route is.
Thank you. That was a comprehensive answer, Paul. Guy, I mean, you ultimately sold Service Plan, but I mean, what did you consider any other routes along the way?
I think we looked at absolutely every single one of those.
Right.
And some of them rule themselves out. You know, if you go private equity, that, or you've probably got a 5-year sort of period to turn it around. You know, for them to sort of sell again. So some things rule themselves out because of time. My business partner Mike, he's a bit older than me now, and I'm not that young, so there's a bit of that that's involved. Essentially, we came down to 2 routes, and the priority was if we could find a good home, culturally right, and needed what we did, and therefore there was a future of the team here to expand and carry on. That would be great. Otherwise, it was an MBO. So those are the 2 options we had in the end. And as it happened, the trade sale came up first because the relationship with Service Plan had built, but over the period of time, as we'd won more business and grown, and obviously the behavioural position was getting noticed, we got inquiries from a number of agencies who are quite interested in talking to us. And so, if you like, more interest in us. The profitability was being addressed that we spoke about earlier, and that was coming right. And so, if you like, the option of which way to go was is getting weighted towards a trade sale, which ultimately carries to probably a better multiple, and it suited the shareholders and actually suited the management team here, who are now definitely have if you like, a growing future with Service Plan. So that was, in the end, it was relatively easy. There's a lot of agonizing about what are the options and so on. But I think it was just simplified by thinking, well, it's a good home or it's a good management buyout, but we did it in the order that came up first.
And then how did you sort of go about deciding on the timing of the exit? Because that's pretty important as well, isn't it?
Yeah, I mean, it's a bit of luck, and a bit of skill. So the skill was, I suppose, getting those things that we could control to get better. So the positioning and the fame was going up in the right direction, and the profitability, thank goodness. But that was moving in the right direction too. The luck was that I think maybe the market was a little bit warmer in 2023, 24 early on. So we were getting approached, but also I think Service Plan really need to realise a London headquarters, and so for them it suited them quite strongly. So if you like, that's the luck bit, and the rest was of course skill.
Thank you. And I guess, like you said, it also is a case of, when you manage to work on some of your key value drivers and optimize those so that you've got the value.
Absolutely. Yeah, it did need to focus on that for a good few years actually to get it in the right place. So it wasn't an overnight thing.
No, never is. Why you need to start thinking about it early doors. Somebody's asked actually, do we have the key value drivers summarized anywhere? Yeah, we could send out a summary actually after this webinar, but actually the very first webinar that we did does talk about key value drivers. So if you want to go on our website and log on and listen to that webinar, then please do. Paul, I mean, we talked about value drivers and optimizing valuation. I mean, given the current M&A market, has there been any changes to the way businesses are valued?
There certainly hasn't been a change to the way that the methodology that they're being valued under. I think George summarised it very well earlier in that for sought after high demand capabilities which are in high demand for businesses that are growing well and performing well. multiples definitely remain resilient. There's so many acquirers out there in the market that have got funding and that actually or need to buy businesses to keep their investors to keep their investors happy is a definite positive. So we're definitely seeing valuations remain resilient for those type of businesses. I'd say for less sought after capabilities, there's probably more downward pressure on multiples. It's probably harder for some businesses to find buyers, and I think you see a lot of buyers circling over similar types of capabilities, and some of those which George mentioned earlier. I know everybody on this webinar would love to know what that means in practical terms, and I hate being put on the spot and being asked for a specific number. But the vast majority of agencies it's probably in the range of 4 to 9. Where exactly you sit depends on scale, depends on capability, depends on growth rates. Ultimately, valuations and multiples are based on an expectation of future earnings, and so the higher the multiple depends on the level of growth that is growth that is possible, and that's very much linked to where the in-demand capabilities lie. So you heard from George around how social commerce, influencer, there's growth in that sector from a client spend perspective, and so the earnings are expected to be higher, and so the multiples are probably at the top of that range. And actually, but if you look at the headline multiple, would be a lot higher still. And what I mean by the headline multiple is if you take all of the possible consideration through the earn out, and you divide that by your current earnings, you could potentially get to a very high multiple. I guess my point there is that I'd be wary of pub chat, is what I call it, where people are saying, "Oh, I sold my business for 20x." Well, if you divide your average profits by the amount of money you receive, what was that actually? How did that actually compute to in terms of the fundamentals of the deal? I think my final point is that I think the way to counteract this, and the way that I would always encourage clients to think about deals, are how much are you getting on day one? That is the only thing that's guaranteed. How much could you be getting on day 1,000? Because that takes into account culture, synergies, the deal structure, and of course, valuation is part of that.
I mean, you mentioned deal structure there. Has there been much change in the way deals are structured?
I think the average deal is still 50% upfront and a 3-year earn out. When times are harder, so we saw this in the early part of COVID, the deals that happened, and at the moment, and currently at the moment with the tougher macroeconomic climate, what you see is buyers being wanting to manage risk through transactions better, and they get how they do that is by reducing the amount of cash they pay. They pay up front, and they say to the management team and the shareholders, well, if you back yourself to be able to deliver the growth plan, then you'll be rewarded handsomely. I think more broadly, and again relating to the fragmentation of the market, we've seen more variation in deal structures within that mix. There was a process we ran, and we received 8 offers for a particular buyer. I think that is definitely at the high end. You should, if you're taking your business to market, I wouldn't go in with the expectation of 8 offers, but we did on this particular case. And I think whilst probably the median offer was the 50% upfront 3-year earn out, the variation within that was quite stark. So at one end, we had one offer was 100% cash and shares upfront. The other end was 70% upfront, a 3-year earn out, but that earn out wasn't based on financials. It was based on non-financial KPIs such as staff retention, client satisfaction. And then on top of that, there was also, because of the PE interest as well, there was a lot of equity incentives, so getting shares in a private equity backed group, and you would part of your consideration was linked to being able to was linked to effectively that private equity backed group's next transaction. So one of the advantages of that for the buyer is it's encouraging incentivization and encouraging you to drive performance, so to create a goal alignment.
Thank you. We're just looking. We've had a question come in for you, Guy. It's as to what extent did you and Mike keep your staff informed of your plans to sell and the actual sale process itself, both the sort of the top key senior leadership team, the MI management and the wider team, and did staff share your enthusiasm for the deal? Well, that's a really good question, actually.
Okay, so probably came from one of our guys instantly. I think we sort of did a reasonable job actually of keeping people informed. Certainly the board, they knew what we were doing every inch of the way. The next layer, as anything significant happened, we shared that. And with the staff, we kept that back actually for a while until actually we'd progressed some way and then made an announcement, because we felt that it could be destabilizing if you go into something and it doesn't happen. So that was the logic behind that. I think we'd been working with them for some time, so it was a known, which was good. So we had a number of clients we were handling on their behalf in London, for example, and vice versa. So I think the relationship had been going for some time before they showed an interest in buying, but at least we knew who they were, what they were like, and vice versa.
Thank you. Paul, so what would your experience be on sort of deals? What's the norm in terms of sharing the information with the wider team?
So I think it is always unique to the business. I think you generally want to keep it under wraps until as late as possible for the majority of the organization, in case it doesn't happen or things change. And so that the communication around the deal is very, very important. Probably the grey area is around the option holder pool, because depending on the seniority of people that have options, you may have some people that know about it or some people that don't know about it. As a business going to market, you want to make sure that you've got any buyer is going to want to meet the key personnel, and so definitely it's highly likely you're going to want certainly a number of option holders in the loop throughout the process, because particularly if you're in a situation where you're positioning the second tier management team as the people that are really going to be driving value, you want them to be meeting the buyers from the start and presenting their vision for the business and how they can create synergies and opportunities and create value through the group. So I think that's probably every situation is unique, but key people only would be my overriding recommendation.
Yeah, thank you. Guy, I mean, before you started the sale process, what steps did you take with sort of the wider team around you to ensure that you were sort of set up for success?
Okay, well, there's a number of things we did, and there is a slight order in it, if you like, chronological. First of all, you say that there's an ambition to sell at some point, whether it's internally or externally, but for reasons of, if you like, retirement at some point, definitely Mike, and then obviously secondary myself, this was going to happen. It's sort of not something you can ignore. What we did is involve them in deciding on and creating the positioning. And actually, that Tom Laranjo, our CEO now, he was an anthropologist, and he came up with this concept quite a long time ago. And it was very, very smart and very distinctive. So it was getting that going and getting belief and substance behind it. second thing was to get our M&A team and legal advisors in place. So MKS, Paul, we've obviously known for a while, and give them a plug. Osmond Clark, they're very good. They helped us with the sale very much, and also PR. If that's important to your company, then get someone who understands you and you understand. EMI scheme came next. That was really important to get right, and obviously subsequently for the next layer. And then the last phase was, which actually can overlap with all of that, is just get to know who might want to buy you out in the market. You just meet them, have lunch or whatever it is, and there's no commitments or anything, but it's just being aware of who they are and make sure that they're aware of who you are too. And it can do no harm whatsoever.
You're nearly 12 months post the deal now. How have those 12 months gone?
Very quickly. It's been quick. I've got a completely different role. I'm a chairman now as opposed to CEO, which is fitting, I think. I think there've been a lot of opportunities for the team, which we hoped for. So they're traveling internationally a lot, which is quite exciting, and they're doing broader roles. And the behavioural work is now getting a much bigger, if you like, market, albeit an internal market now. So that's great. It's really what we hoped for. It's sort of a good home. And I guess we've got more services we can offer. So the service plan have a lot of, if you like, tools that we don't or we didn't have. So there's that. So it's busy. We are still integrating, and there's no question about that. We're going to be seeing a lot more people from Munich in the office, I think, over the next 12 months or so. But by and large, so far so good. It's probably the best way to put it.
That's good. It's good to hear. I mean, what about integration? I mean, that's pretty key for any deal, isn't it? How's that gone?
It's gone well. I mean, to be fair to them, they've been fairly hands off. They just want us to sort of get on with it. I think that will probably change as time goes by. But they've been very good about letting us go as long as we let them know exactly how it's going financially and any other things. They've been clear about what their plans are here in London, and obviously we'll work with them to work with us to help make that happen. So integration is good, and we've known them a long time. So the chemistry is there from kind of the start, and that starts really very much at the top. So Florian, we all get on with at a senior level, and he's very, if you like, empathetic the other way. So that's important, and that gets felt, if you like, across both organisations.
Yeah, it's really, really important, isn't it? Really important. So I think that sort of brings me to the end of the questions that I had. So I think just to end on a final question, really, what would your top tips be, really, for anyone considering an exit? So maybe, Guy, stick with you. You go first.
Right. Okay. I would say the number one thing, because media buying. Okay, there could be other industries listening in. It's a pretty uniform market, and you need to stand out and give reasons to why would they want to buy you. And so I think getting the positioning right, make it credible and evidential is important. I would just focus on that. The fame will happen. You can use PR to get that, and if you've got your positioning right, the profitability will probably happen too.
Thank you, Guy. And Paul, what about you?
Mine is never too early to start planning, and I think that linking to Guy's point in terms of working on the proposition, the proposition in advance of whatever exit route you take is really, really important. As an advisor, the most frustrating thing is when someone comes to me and says, I want to sell my business, I want to sell it now. Typically, this means they're not ready to. Typically, the business isn't in a place that is ready to sell, or value is being left on the table. Businesses that do plan, I think Total were a great example of this. They've got multiple exit routes available. They've really worked on optimizing the valuation. They trade better, and that leads to better outcomes all around.
Yeah, definitely. Thank you, Paul. Well, that brings us to the end of our webinar with 4 minutes to spare. So that is good. 4 minutes back in your diary. So thank you very much, Guy and Paul, for all of your insight. I'm sure all our delegates have learned a lot from that. Thank you all very much, everyone, for attending. Please do fill out that feedback form. That is super, super useful. Please do take a look at our agency exit programme. Paul talked about starting that planning journey, as did Guy actually mentioned starting planning early doors. So do have a look at that, because that covers all of the key areas that one would need to think about in terms of planning for that ultimate exit, which, you know, is usually a once in a lifetime event, and you need to make sure that you get it right and optimize the value. This was the fourth in this mini series, so please do go back if you've missed any of the other webinars, and all available on our website. So please do go back and have a watch of those to fill in any of the missing pieces of the jigsaw. I don't think we've quite finalised yet what our next mini series is going to focus on, but we're working on it. So we will definitely let you all know in due course when we're going to kickstart the next mini series. So thanks all of you, because there's been a sort of a core team of you that have joined most of these webinars. So thanks for listening, and we look forward to seeing you on our next mini series. Thank you very much. Enjoy the rest of your day. Thank you.